15.6 million UK adults are now investing.
Stock pickers continue to see opportunity.
What are your predictions for 2025?
We've got Donald Trump policies that he talked about on his way to the White House. We are very impacted by what happens in their economy.
Today I've asked Alexandra from Waverton to come in and just talk to me about what she learnt from last year, what she's going to be looking out for in 2025 and her expectations of the portfolio. So welcome Alexandra and thanks for your time.
Pleasure.
So you're a portfolio manager at Waverton. I was very impressed when I looked to see that you have won the PAM 40 under 40 shortlist, not just once but 3 times. And I'm told that you currently look after about £500 million of clients' money. Tell us about last year. What was it like in your shoes? Was it a rocky year? Was it one of those years where you actually can relax?
Definitely not relaxing. I think last year was interesting because there was a bit of a dichotomy between all the risks that we read about on the front pages of our newspaper and then what equity markets were doing. So we had massive geopolitical upheaval, loads of countries voting in new heads of state, war in the Ukraine, war in the Middle East, really terrible things going on in the world. Meanwhile, companies continued to report good profits, good growth, economies sort of kept ticking over and doing well. And actually, in the end, it was only it's the first time since 1998 that we've had 2 subsequent years of 20+% increases in equity markets. So we had this big dichotomy going on, which was interesting because from a sort of top-down perspective, it felt like we should be reducing risk in the portfolios. But then our stock pickers, the people finding the investment ideas, continued to see opportunity and wanted to keep investing.
And I expected clients were possibly more on the nervous side last year.
Yeah, I think that's probably the case. I mean, as I say, that the front page of the newspaper and the news every evening telling you all these terrible things that are going on in the world feels like a strange time to be in the slightly overweight equities camp. But that investment did pay off over the year and the returns to clients were really good. Now, under the surface, it's again quite a complicated picture, even just within equity markets. The year was dominated by the Magnificent Seven once again.
And so for people who don't know what the Magnificent Seven is, what is it, or remind us?
So it's 7 extremely large tech companies that dominate the US stock market and also feature heavily in all of our lives. So Microsoft, which most people will use every day, Amazon, Alphabet, which is Google, and then Apple, Nvidia, Meta, which is Facebook, Instagram, etc., and Tesla. And they've dominated the market in terms of returns for a number of years. When they are volatile, they can be very volatile and they pull the whole market down with them. But the decision to either be invested or not into those companies has driven a huge amount of returns for investment managers over the last year.
And are there any that you've chosen not to invest in?
Yeah, there are. So the ones that we hold in our portfolios are Microsoft, Amazon and Alphabet, all of which we think meet all of our criteria in terms of the sustainability of their cash flows, the strength of their business models, their management teams, decision making, and the valuation of the shares. And all the others we don't hold in our portfolios, some of which have been quite painful over the last year. Yeah. So not holding Nvidia, which is the world's largest chip maker. They make the semiconductors, chips that go into AI, effectively, GPUs. They've got a massive market dominance in manufacturing GPUs, which all of the tech companies are buying up to try to make their Copilot or ChatGPT or whatever their AI software is work. And we haven't held them because we think the shares are too expensive. And we think that their profit margins, gross profits, are up at about 75%. We don't think that that's sustainable. And we also think that the market is desperate for a number 2 to come in because Nvidia basically have full pricing power. So they can double the cost of those GPUs and the tech companies will have to pay it because they're at the whim of Nvidia.
And are there other companies and competitors bubbling away?
Yeah, there are. So there's a company called Advanced Micro Devices, which share price performance has been very poor compared to Nvidia, but they are trying to compete as a number 2 and the tech companies are calling out for them and crying out for them to be a success. But they're still at the early stages with their GPUs. We really like the story long term, so we think it's a good stock, but it hasn't had anything like the performance that Nvidia has had. The other thing to think about in terms of change of market share is that people are trying to develop new forms of chips. So this chip, the GPU, is called a graphic processing unit. And it was originally designed for video games, which is why it can work very quickly and has very high power, effectively. They're looking at ways of creating newer chips that do precise things for AI that are lower power and lower cost. But that's going to take a few years to come through.
That sounds like it would be more sustainable as well.
Precisely. So they're saying that if you do a search on ChatGPT versus just on Google, I think it uses between 6 and 10 times more power.
No way.
Yeah. So I saw someone talking about this the other day. If you do 10 prompts into ChatGPT, it's equivalent of pouring away a 2-litre bottle of water down the drain. Because they need so much water to cool the system, because they've got these huge computers and they need all this cold water flowing through them to cool the system.
10 prompts is 2 litres of water.
That's anecdotal. I saw that on the internet, but regardless of the precise amount, it is much more energy intensive.
I hadn't even thought of it.
I know, you don't think about it.
No.
So it's quite interesting from an investing perspective as well. If you think about ESG investing, and we're focusing on, trying to make oil companies improve or trying to invest in renewable energy, actually at the other end of the spectrum, we've got tech companies using up huge amounts of energy.
Yeah.
I know Microsoft's had issues with that. And then a lot of these Bitcoin mining companies as well, where they're using huge amounts of computer processing. A lot of those have now been put up in the Arctic Circle, where it's very cold, so they don't have to spend as much money cooling it.
What are your predictions? And we won't hold you to it, but what are your predictions for 2025? Are there things you're nervous about, things you're excited about?
Yeah, definitely things we're nervous about. So what's been on the market's mind over the last couple of months, and what's resulted in this bit of volatility from a bond perspective and bonds being repriced, is fears around what the inflation outlook is, and as a result, what the interest rate outlook is. So just casting our minds back a little bit, in the post-COVID era and exacerbated by the war in Ukraine, we saw a huge spike in inflation. The expectation was that that would come down very quickly and normalise, and central banks raised interest rates to try and cool the market down, and the expectation was that that would also come down quickly and normalise. Now, inflation was stickier than people were expecting, hung around a lot longer. Your listeners will know that from their energy bills or their weekly shop. It hasn't come down in the way people were hoping, and as a result, interest rates have not come down as quickly either. So again, your listeners will know that from their mortgages, which inevitably will be.
I mean, at the moment, it's at the time of recording, it's January 2025, and the mortgage broker that we use, he's saying people need to get rates booked now if they've got a deal coming up in the next 6 months, because the 2-year swap rates have gone mental.
Part of what's fueling that is looking at America first of all. So we've got Donald Trump, and a number of the policies that he talked about on his way to the White House are likely to have an inflationary impact. And inflation in the States almost always results in inflation here. The saying is America sneezes and Europe gets a cold. We are very impacted by what happens in their economy. So if we look at his key policy being tariffs, talking about putting 20% tariffs on all imports of Chinese goods, that's going to lead to inflation almost inevitably. Some of his talk about trying to deport people, reducing the labour force, that also results in inflation. Yes. So that's a big risk on the horizon, and how central banks manage to deal with that and work through that is going to be a challenge. In the UK, we've got our own set of challenges from an inflationary perspective. One, that we import almost all of our energy, which means we're at the whim of energy prices. And then some of the actions that have come out of Rachel Reeves' budget in terms of national insurance, for example, is also likely to result in some wage inflation. So the picture's not going back to this sort of Goldilocks, low inflation, reasonable interest rate period that we've experienced before. So I think overall, we're probably in for a rockier year than we've had over the last couple of years.
And are there opportunities from Trump being in power?
Yeah, there are. So from a stock market perspective, we've looked at a number of companies that could benefit if some of his building work does take place. So he's talked about wanting to onshore factories, make more chips in America, everything to make America great again. Yeah. All of those things could result in building and infrastructure work. So we've invested into some companies that are exposed to that, which could be good news. He also talks a lot about deregulation, which poses its own set of risks, but can be beneficial for some companies. So
like the financial sector.
Investment banks did really well on the day of the election, the day that the result was announced, on the expectation of more mergers, more acquisitions, just more things happening in the financial markets. If we look at his last term of presidency, the stock market's performed very well, and he used the S&P 500 as one of his KPIs. He wants the stock market to do well, even though some of the things he's announced are probably detrimental to stock markets. I think ultimately he sees that as a badge of honor if stock markets do well. So I think, I wouldn't be betting against him when it comes to what the stock market will be like in 4 years' time.
What about other countries? Are there other areas that maybe people are underexposed to naturally in a portfolio, especially if they're trackers that you're looking at?
Yeah, we're really interested in Japan, actually, and we have been for a little while. It's one of those areas where people feel reticence towards because they've been stung in the past. People have invested in Japan and it's been very dull or negative. We think there's some really good structural changes going on in the country that mean there's great opportunities there. It's exposed to really good themes. So some of the stocks that we're invested in there are exposed to energy transition, automation, lots of great long-term themes that we think are going to get investment over the coming years. The topic, so the stock exchange in Japan is imposing some new rules. That means companies need to be clearer with shareholders about what they're doing, invest their capital more effectively, more efficiently. Sort of historically, Japanese companies were focused on the family who owned them, and then the employee, and finally the shareholder. And that is slightly changing to move to a more of an American model where they're thinking about the shareholder more, which we think is beneficial. And we're finding some really interesting stocks to invest in there.
To take a bit of a sideways jump, thinking about investing. So I read, the FCA have said that 15.6 million UK adults are now investing, which is great. And they have more than £10,000 in investments. But we also know that we're cash hoarders, especially females are cash hoarders. And it says in the same study, 30% of us hold money entirely in cash. And I'm noticing that people are already saying to me, I'm happy to invest, but we've had such brilliant last few years. I want you to drip feed it in for me over 3 months, 6 months. What would you say? Would you want people to? Well, let's break it down. Why do you think people don't invest, and why should they?
I think people don't invest for a few reasons. I think number one is probably just not knowing where to start, which is why speaking to an advisor like you is a great place to start from that perspective. If you're not experienced in it, it can feel quite overwhelming. That's when having an advisor is really helpful. Get everything set up, sort of talk you through it, make sure what you're doing is sensible. I think people worry about, what if something happens? So that part of it's really important to have that, be it 3 months or 6 months cash reserve built up that you tuck away. And hopefully that's the thing that allows you to sleep at night. If you or your partner lose your job, you can keep paying the bills and you're going to be fine for a period of time. So I think that's really important psychologically. And then to get into the market, I think, start small. You don't need to go all in really quickly. Start with things that you understand and try and keep it simple. So an equity market tracker is a good example, where you're drip feeding into that and you're getting global exposure. Start slowly, build it up over time. The risk of investing is volatility. So markets are going to go up and down, and you have to be mentally prepared for that. But the risk of not investing is that inflation is going to erode away the value of your capital. Yeah. So if you have £1,000 now and you invested into equity markets, and say they produce similar returns to how they've done for the previous 10 and the 10 before that and the 10 before that, in 10 years' time, if you're going up to about 7%, your money's going to double. So you're going to have £2,000, very rough estimate. If, however, you just sit on that money in cash and inflation runs at 3%, say, in 10 years' time, you're not going to have £1,000. You're going to have £750, there or thereabouts. So the differential between investing and not investing is £1,250 in that example. It's massive. Yeah. So the cost of not investing, I think, is something that people overlook, maybe underestimate.
And I think if you're nervous to invest, a trick that I do with clients is, let's just not make the situation worse, so you don't accumulate more cash first. So if you look at historically on average, what are you accumulating in cash a month? And let's start by just investing that. And then as you get more confidence in being invested, then you can start to reduce your cash if you really are nervous. And I think another good rule of thumb is always don't invest money that you think you're going to need in the next 3 to 5 years, because if you absolutely don't need this money in 5 years, you can afford to invest it, and you can afford for it to fall before it goes back up again. So I think time frame is important.
It's one of the first things we always discuss with our clients as well. And I think from that perspective, easy wins for people are pensions and 𝗖𝗍s. So pensions, if you're in your 30s or 40s, you know you've got a good long time horizon,
and you can't get it out.
You can't get it out anyway. So you might as well go full tilt. I always say this to my friends: go all equity in your pension, go really high risk, and just don't look at it for 20 years. And trust me, in 20 years, it's going to be a lot bigger than it is today. And 𝗖𝗍s are similar. If you're tucking money away for your child and they're 1, 2, 3 years old, you've got a good time horizon there till
they
they're
can't
18.
touch it.
Can't touch it. So that's a good place. And I think once people start investing, it maybe experience that first fall and the recovery and get a few good years under their belt, they're going to feel a lot more confident, because a lot of it's just about confidence, about trusting somebody, getting some good advice, and then feeling like you're on sort of level playing field.
And I think at the moment, the hot topics that are out there is tech and the US, and you often will see somebody will be 100% in, say, an S&P 500 tracker or something like that. What's the counter argument? How do you convince people to give up some of those potential short-term gains that they'll make and have a more diversified portfolio?
I think you point to previous periods of volatility. So we can look back at 2022, for example, when tech stocks fell significantly.
I think we forget that, though, don't we?
I know. And in those period of times, having some other stock markets, having some gold, having some alternative assets, those things can help you in those periods.
So looking back at previous downturns to just remind yourself that things can go down in these industries. And
and I think if you look at how the market's positioned right now, the US tech stocks make up a huge proportion of the market, and markets are at a historically high level of concentration. So there's never been a period going back all the way to the 1930s when so few stocks have made up so much of the market. And we think there's an inherent risk in that, because if they fall, they're going to fall hard. And the other point to make is that index trackers actually exacerbate the issue. So say those stocks make up 30% of the market, and then they perform well and go up to 35, all the trackers have to buy another 5% to keep up. And that buying feeds into the stock market, the stocks going up even more. So you end up in this kind of vicious cycle on the way up. But what investors have to remember is the same thing works on the way down. So if those stocks fall down to 25%, all the trackers have to sell 5%. And then you end up in a sort of potentially in a downward spiral where those stocks go down.
I suppose from that point of view, it's a very short-term focus on what the market's doing right now, rather than holding something for the right reasons for that medium to long term.
Trackers are sort of, in some ways, they're looking to yesterday. So they're saying, what was big yesterday, I'll have that amount today. Whereas the way we invest actively, so it's a different approach. We're trying to look at what's going to happen in 5 years' time. So which of these stocks are still going to be around in dominance in 5 years' time, or indeed 10 years' time.
Do you personally ever have any tracker investing yourself, or are you solely in 100% on active management?
I'm 100% in active management.
Would you be allowed to say
practice what I preach? Yeah, I probably wouldn't. No, practice what I preach. I think the type of stock that we invest in, the way we invest, gives us a really good spread. So from a geographical and sector perspective, I've got a good mixture. And then I think this type of quality company that we focus on appeals to me. So generally market leaders in whatever industry they're in, number one or number two player, and there's sustainability to what they're doing in terms of, we still think they're going to be the market leader in 5 years' time. So that appeals to the way I think about
And what
investing.
would you say to the true tracker investor that say, yeah, but you're 3-4 times more expensive?
It's a good point, but then if you show your performance figures net of fees, that takes that into account. So, in periods when markets are weak, if we can protect 2, 3, 4%, you're probably happy to pay that little bit extra in terms of fees.
I think that's a really good point about the protection on the way down, because if you're in a tracker and things are going down, you're also going down at the same rate, and there's not a lot you can do about that.
No.
But what tools do you have to protect against the downside that a tracker wouldn't?
So there are stocks that we don't hold. That's one of the ways that we're protecting. So some of those very expensive stocks that will fall hardest, we avoid them and don't hold them. We only hold quality stocks, so we're ruling out a lot of stocks that may not have the ability to set their own prices, or they may have a poor management team, things like that. We're ruling all of those out. So the ones that we hold generally are the quality ones. The way I think about it, this is a colleague's way of describing it, but I think it's useful. So we try to invest in the oak trees, and when a storm comes through, it knocks away all the other weaker trees. The oak tree just has more space to grow. That's the kind of company that we like to invest in.
That's a good picture to have in your head. Okay, and any last points you'd like to make for 2025?
I think, as I say, I don't think equity markets are going to be able to perform in the same way that they have. I hope that we see some reduction in the concentration in markets, because I think it's healthy for stock markets and it's better for risk and investing if the market is more broad.
Yeah.
And I do think there are going to be some great individual stocks to pick out that can benefit from what's going on in the US and indeed the rest of the world.
Amazing. Well, thank you very much.
Pleasure.